the U.S. could monetize their balance sheet and really help pay off some of this debt really quickly if they chose to. So there are other avenues out there that you could go after. But to your point, simply said, raise taxes, cut spending, or inflate the way out is the most likely answer.
All right, welcome everyone. I'm Chad Carson. A lot of people call me Coach Carson, and I'm here with Michael on Michael's show. I'm just doing the intro today. And one of the things I told Michael I wanted to talk to him about, I heard another YouTube video, and it's basically another real estate investor made the case for rising interest rates over the next 5 to 10 years, or higher interest rates. So, and then also made the case for why they might stay flat, and another case why they might go down. And as we all know, interest rates are a huge topic for all of us who in real estate investing, because we either use mortgages or our buyers use mortgages. It affects the rents. And I don't know anybody better that I want to talk to so that I can learn about it than Michael Zuber. So Michael, can we go into that? Can we pick your brain about this topic?
Yeah, this will be fun because we're doing this in real time and haven't had time to prepare. But I like the idea of steel manning. Rates go higher, rates stay flat, or rates go down. And then maybe at the end, we can talk about what we think is most likely. But this should be a fun mental exercise. So where do you want to go first?
Let's go up, because I think I think there's a hope in so many real estate investors' minds that, like, it's going to either stay flat or it's going to go down at some point, and then I'm going to refinance. But break that that illusion and say, well, maybe they're going to just keep going up, and we're going to have like 1980s style or something like that, where it was up for a long time.
Yeah. So I agree that this is certainly a possibility, and we don't have to go back very far in history to see this in action. If we just go back to September of 2024, we had a weak job number. We had an 818,000 job correction. The Fed freaked out, and the Fed delivered a 50 basis point cut to start a cutting cycle that ultimately cut 100 basis points on the front end. But what happened on the long end, or mortgage rates, is they went up roughly 100 points. And at the time, that broke people's brains, because we had been conditioned to believe if the Fed cuts, mortgage rates go down. But hopefully by now, we all realize that that is not true. The Fed only controls the overnight lending. It is influenced up to the 2-year, but the 10-year note, the 30-year note, 30-year mortgages are controlled by, the bond market. It's much bigger than just the Fed. So, there are a lot of things that could go bad and have mortgage rates go up from here. For example, inflation could take hold. Next, we could see wage spiral inflation. And now many people may not think that's bad, but you have to realize in a service-based economy, wages are the largest contributor to costs for businesses. So if we continue to see weak participation rate, we continue to see, baby boomers retire, migration, all of that stuff go on. We could get to a point. In one analyst at JP Morgan just yesterday said he expects employment to be flat for 5 years. That could be inflationary, right? Because you're basically competing for talent, right? You're competing for people. So that could take things higher. Next, we obviously have, I think it's $38 trillion in government debt. It seemingly is not a problem today, but at some point in the future, mathematically will be a problem. We don't know when that is. And, when that happens, people are going to demand higher rates on the 10-year and 30-year. And then lastly, we'll just throw out there one more thing that can happen, the yen carry trade, which is it's rather complex, but think of it simply. You borrow at a low rate, you invest in a high rate. If that was forced to unwind, it'd be trillions of dollars coming out, which would send our treasuries higher and thus mortgage rates higher. There are lots of things that could go sideways to take rates higher.
Yeah, so many things to think about there. The one that really circled in my mind, Michael, was the government debt issue. I hear like Ray Dalio talk a lot. You hear a lot of people who discuss government debt have alarm bells on that one thing. And to me, tell me if I'm oversimplifying this, but you have, on the one hand, you can kind of fix that issue by raising revenue, taxes, haven't seen that one happen in a long time, or cutting cost, another kind of laughable thing, right? So those seem so improbable in the political environment I've seen, that it seems like the other fork in the road is printing money, higher interest rates. That whole is that one way to think about it, or am I oversimplifying that?
No, I think you're. For most of us, I think that's right. There's only 3 ways you can get past this: raise taxes, cut spending, or inflate your way out. And I think most people have come to realize that inflation's a feature, not a bug. So they're going to inflate their way out. But there is a fourth way that not many people talk about. The United States holds a lot of assets on its balance sheet. Think land, think gold, think all of these things that the US government owns on their balance sheet, and they're not valued correctly. The US could monetize their balance sheet and really help pay off some of this debt really quickly if they chose to. So there are other avenues out there that you could go after. But to your point, simply said, raise taxes, cut spending, or inflate the way out is the most likely answer.
All right. So there are multiple potential pressures on higher rates. So that's something we as real estate investors, as we're doing our planning and we're thinking about, hey, am I going to have a balloon rate coming due 3 to 5 years from now? Do I need to maybe think about the fact that that could be possibly higher? Maybe, right? There's a possibility there, a probability there. Tell me about the flat case though. We're just going to bob around here for the next 5 years, and this is where we're going to land long run.
Yeah, I think that, I think this is a real possibility, and it's really fun to think about. We're talking about the next 5 years, but if we really step back and not even back that far, we've been in this range for about 2.5 years. So we've been between 6.5 and 7, maybe 7.1 for 2.5, maybe 3 years. And who's to say that's actually normal if you go back 50 years. I think the average mortgage rate, if you go back 50 years, is like 7.25 or 7.33. So we're right around historical averages. And again, in an environment with crazy debt, in an environment of slow growth, it's not unreasonable to have a 10-year note at 4%, right? Again, this environment that we got so addicted to with ZIRP, right? First the dot-com crash, then the Great Recession, then COVID. That's not normal. We should not count on zero interest rate. Going to zero is supposed to be like pull the ripcord, emergency, last resort. I hope we never go back there, right? Even though I'm a real estate investor with tens of $millions in debt, I don't want to go back to zero. That unleashes all kinds of bad things that we pay for in the future. So if we can get through this, and we have 3, 4, 5 years of just sideways motion, that's probably, honestly, Chad, that's probably the most healthy outcome. It's going to feel slow. It's not going to be enough transactions. It's going to feel like you're walking in mud, but we don't have a big black swan. It doesn't blow up and, billions of dollars or trillions of dollars are lost in something. So, hoping for sideways is, it's probably the best answer.
I agree. And also you think about it from business, it is a larger community, but also real estate investors and small money and one rental at a time investors. It's once you have a predictable interest rate market, then you can adjust. You can adjust your strategies. You can adjust your mindset. Buyers and sellers kind of adjust their expectations. But when things just go up and down and left and right, that's hard. That's hard to get your head around. That's hard to understand.
Yeah, and the other thing I want to say about going sideways and why it's the one I hope we do is it'll take a while to wring out what I'll call the bad deals. I think we all understand that there were some bad deals that were done and people are holding on by their fingernails. Those just got to get cleaned out, whether it's office building or Class B and Class C multifamily or busted Airbnbs or whatever it is. There were some deals done that frankly shouldn't have been done, and losses are part of the process. But if we had rates just suddenly crash, some of those people would be bailed out and they wouldn't learn the lesson. Right. Part of real estate is losing, and you've got to learn the lesson. I think going sideways for another 2 or 3 years, will unfortunately bring those lessons to bear, but also where there are lessons, there are opportunity, right? I'm looking for opportunity with maybe somebody who overpaid or a foreclosure or something of that nature. So yeah, I don't want rates to crash to bail people out for bad behavior. It's not something I would want to see.
Can you make the case for rates falling? Is there a possibility of there's some tailwinds that could make that happen?
Absolutely. I mean, there all three of these are real possibilities. And, I think we've already started to see it. We for the longest time this year, Chad, we believed that the job market was solid. And the general feeling was inflation was the boogeyman because we just believed the government statistics and the job market was fine, right? We've been at 4.2% unemployment or better for over a year. So nobody was worried about the job market. And that's why rates were up. That's why rates were, the 10-year treasury is at 4.3. It's why mortgages were 7%. And then suddenly we woke up on Friday morning, or at least on the West Coast, we woke up to revisions in the job market that were so negative, it hadn't happened since 1968. 1968 was the last time this happened. And if you want to see a violent move, pull up the chart of the 2-year note. The 2-year note was trading at about 2.6, I think. And it fell a quarter, 25 basis points in an hour. That is not normal. The spread between the 2-year and the 10-year now, or the 2-year, the 2-year and the 10-year now is like 70 basis points. Or I'm sorry, the 2-year and the Fed rate. So the Fed rate's 4.25. The 2-year note's like 3.5 or something. So the market, the smart money, is betting on rate cuts. And unlike last time, again, as we open with rates going higher, the move was aggressive. It was a surprise. It was 50 basis points, and it was proved to be too early. And thus the bond market said, you're just stoking inflation. Right now, I think there is a general impression that the job market is much, much, much weaker than the government numbers. There is a general impression that JP Morgan, Goldman Sachs saying the US economy is at stall speed, right? Basically 1%, which is below inflation, not good. So there are, now they're pricing in 3 rate cuts this year, September, October, and December, all 3. There's only 3 meetings left. We're going to according to the smart money, get a cut at each meeting. I'm calling for a 50 basis point cut in September, just like last year. And I think this time, because the economy is weak and getting weaker, there's a very good chance that mortgage rates fall. So, standing here today, August 5th, where do I expect mortgage rates to be by December 31st? Just completely off the top of my head, I would probably say 60% they're lower than they are today, right? If you want to mark August 5th by December 31st, probably 30% they're the same plus or minus 10 basis points. And maybe I guess the last is 10% or 10% chance they go much higher from here. I just think, so if we go back to the argument for higher, you actually asked the second question was debt. I think there's a pretty good chance that tariff collection last month was 29.6 billion. Let's call it 30 between friends. That's 360 billion a year. That could be enough to bend the curve, because we don't have to take the national debt from 36 trillion to zero. We just have to show the market that we could bend the curve, and then we will get credit for that, and rates will come down. The other thing that's happening right now, as you know, the real estate market's in a depression. But what you may not know, or the audience may not know, is we have still historically wide spread between the 10-year and the 30-year note. If you go back 50 years, the average spread is 175 basis points. Today, we're still at like 225 basis points. I believe that over the next couple of months, given lack of transactions, people are going to compete that spread away. And even without the 10-year note falling, we will see mortgage rates fall as the historical spread comes more back into line. So I think there's a lot of tailwinds for, again, rates being lower. I'm not talking crazy low. I'm not talking 3%. I'm not talking 4%. I'm talking lower than 6.6. And, those are the odds, 60, 30, 10.
So many good things to talk about there, Michael. I think maybe a good place to go back to is just, here we are as real estate investors. And I'm thinking of a couple specific short-term plays. Like, one is people have been borrowing money over the last couple of years at 8% interest, 7.5% interest, sometimes more as a real estate investor. If you have a chance to refinance at 6% in the next 6 months, shouldn't you be getting that ready to go? That's a huge opportunity, right?
Yeah, I think that's a great way to go. Like, again, my best case scenario for mortgage rates in 2026 is probably like best case, like everything lined up. It still only gets us to like 5.7. So if you could go in and refi 8.5% debt to 6 and set it and forget it, that's a huge savings. Waiting 6 or 9 or gambling for 6 or 9 months to see if Zuber's low end is possible, not worth it, right? Take it now. I think there's a lot of people, and to your other point, I think there's a lot of people that gambled on the, date the rate, marry the house nonsense. They did the 2-year, 1-year buy downs, and they're sucking wind right now, right? They're up at the, 8% or whatever it was at the time they did the loan. So I think if we get rates to 6%, 5.99, I do think is magical. I think it unlocks a lot of refis. maybe even some home sales. And I think we could see 599 sometime early next year.
What does all this mean for how we approach our long-term strategy? I'll give my idea, but I want to hear yours first. Like, so what is Zuber thinking for like the next 10 to 15 years on your investment strategy because of this, or maybe in spite of all this?
I think it's probably in spite of all this. What I keep telling people and have for years and probably will continue to tell them is underwrite your deals at today's capital. 30-year fixed every time. Don't gamble. Don't do teas. Don't do. I hate arms. Right. I'm a buy and hold, set it and forget it guy. Like there's one lender I work with, Convoy Home Loans today. I think that has a 5.5% DSCR loan. You have to buy down to get there. But if I could do a 30-year buy and hold at 5.5, dude, I would set it, forget it all day long. All right. Because they would have to go down to 4.5 or 4 for me to refi that. And I don't think we're getting there out of a, black swan. So I'll take the 30-year money at 5.5 all day long. Even if I have to pay a point or 1.5. Just go get it, underwrite it today. Don't guess. Just underwrite your deals with 30-year cost of capital. Don't gamble.
100%. Yeah, I think my mindset, in some ways, the fundamentals have never changed. To me, it's about buying a location that's high quality, is buying cash flow today, but then also financing definitely makes a big difference. You have to adjust your strategy. It's like a sailboat. You have to adjust the sail to catch the wind where it's going. You're trying to get to the same destination: financial freedom, certain amount of cash flow, certain amount of wealth. Like that hasn't changed. But if you're a sailboat, you have to like tack and go back and forth, and that's the equivalent of the financing. Like you have to adjust your strategy to the current financing market in order to make properties cash flow so that you can hold them over the long run, which is our strategy. That hasn't changed. And so to me, it's buy quality, buy good properties, operate them well, and then pivot and adjust to make financing work depending on where we are.
Yeah, I mean, at the end of the day, I love the way you said that, right? The small and mighty investors, the principles never change. As you own your portfolio, as it ages 5, 10, 8, whatever years, you can have the ability to reposition equity and all of those things. But it all starts with putting together a deal that you can hold forever. And that means you understand the cost of capital. You're not gambling. You're not betting on appreciation. You don't produce alligators. You don't do any of this nonsense. Just high quality properties that cash flow day one. And, then you hold for a decade and you get rich. It's that simple formula.
Yeah. Well, I want to thank you for letting me pick your brain, because I think that your approach, Michael, to the economy and mixing that with real estate investing, to me, is one of the most helpful, because you got some people who like prognosticate and say, this is exactly what's going to happen. But what the exercise you just took us through, where you say, I think probability, kind of I'm leaning towards this, but here's what would happen if it went up. Here's what happened when it goes down. That's exactly how investors think. That they think about things in probabilities, and they think about what would happen if that happens. It's like I always tell people, like a football player. I used to play middle linebacker, and you had these big 350, 400 pound people like coming down to block you. You had to have your head on a swivel for everything. And that's kind of what we have to do with the economy. And so thanks for educating. I'm going to go back and re-listen to this one.
Yeah, this is a lot of fun. I appreciate this. And I could not imagine being blindsided by a guy going 350 running a 4.40. That would leave a mark.
Yeah. It makes you kind of paranoid. You gotta always be you always gotta be on your toes, because it could get ugly fast.
Chad, you're amazing. Where can people find you?
If you look up Coach Carson on YouTube or any podcast platform, I'm there, or look me up on Google, Coach Carson. We'd love to connect with you.
Folks, and also go get his book if you don't have it already, Small and Mighty Investor. Leave him a review. Reviews really help us as authors. So thank you so much.
Thanks, Mike.